Hi, and welcome to our LinkedIn Live special edition on the release of the ISM Supply Chain Planning Forecast. That's formerly the Semiannual Economic Forecast. My name is Dan Zeiger. I'm Senior Writer and Copy Editor for Inside Supply Management. That's Institute for Supply Management's member publication, and we're excited to have you with us today. The forecast is based on responses from the Manufacturing and Services Business Survey panelists that help compile the monthly ISM report on business. It reports recent sector performance provided by purchasing and supply executives on the front lines of the U.S. economy. More importantly, their sentiments for the coming year, and that's especially relevant right now as we prepare to undergo a transfer of power in the U.S. We publish, and we'll drop a link in the chat for you to reference. Manufacturing and services executives expect growth in production, employment, capital investment, and revenues in 2025. Overall, it's a bullish sentiment, but there are still a number of uncertainties, and we'll discuss a lot of them today. Like we do with the monthly manufacturing PMI and services PMI broadcast, we'll get insights straight from the sources. So I'm pleased to be joined by Tim Fiore. He's the chair of the ISM Manufacturing Business Survey. You got some great insights from both of you, and really eager to expand on those in our session today. And I guess the main bullet point is that familiar phrase, and it was the headline in our story, cautious optimism. And we'll just start out with what stood out to you guys in the report. Tim, we'll start with you. What were some of the key points on the manufacturing side?
Yeah, thanks, Dan. Hi, Steve. So,
hey, Tim.
Confused. I'm a little bit confused. I'm a little bit disappointed. I really expected the forecast to be much more upbeat. Not that it's not upbeat, but there's an element of conservatism in here that you got to dig through a lot of the information to kind of figure out what might be going on. Remember, these business executives have to kind of take all the input, global, national, political, Federal Reserve, and come up with a plan that it doesn't matter what the excuse is in the end. You have to meet that plan or not meet the plan. So I think what we have here is we have a little bit of conservatism in our 2025 plan because of all the unknowns. So let me, for instance, we're planning on growing at less than 5% revenue growth, which in better times, that number has been higher than 5, 7, maybe. We're still seeing a price growth of 3% in 2025. By the way, we think we saw 3% in 2024, which is about a point higher than what I would have thought at this point in the year. We're going to expand our employment by less than 1%, which is a bit of a surprise. In 2024, we reduced our headcount by over 1%. So there's a lot of stuff going on in this report. We should kind of dig into it. The outlook is definitely positive. The business comparison between half one of 25 and half two of 24 and half one of 25 against half two of 25 is very interesting. We should dig into that side. And then let's get into the cost side, Dan, and we'll get into the investment side too.
Yeah, okay. Dan, on the
Steve, why don't you give us your?
On the services side, it seems pretty consistent with what we've been seeing in the monthly updates of kind of a 52%. Kind of slow growth but consistent growth. We're not recovering from a contraction period, but kind of continuing the stable low growth. What we saw kind of in a collection of the numbers, very similar, identical to Tim's on the labor growth, 0.8% projected for next year, although a projection of revenue growth of 3.9%. And prices expected to increase, prices paid by 5.3% next year. So I think there's a healthy sense of optimism in terms of the service sector being able to build productivity and generate a higher operating rate than they have in 2024, because otherwise the numbers, when you look at them all together, don't work. Expecting a higher profit margin with higher prices than what you're seeing on your revenue growth side means you got to be getting the cost out somewhere, and it looks like it's going to be efficient labor practices with some additional capital investment.
Yeah, you want to, as we start to drill down into some of the particular numbers. I know Tim wanted to talk about cost and investment. I mean, capital expenditures, manufacturing, they project a 5.2% increase in 2025. In services, it's expected to increase 5.1%. I mean, obviously, as we talk about often, that's typically a good barometer of company confidence. I mean, we'll start with you, Tim. I mean, are those pretty much what you expected?
Not really. So, we're closing 2024 at a 5.6% growth in CapEx. The prior year was 15%. So, but we had forecast something quite a bit less in May. So it ended up to be a decent CapEx year, but more importantly, we're only figuring 5.2% CapEx in 2025, which is pretty low, given the fact that we're probably looking at a 2 to 3 year grow out here now. And to only put 5.2% of incremental capital up for 25 is a bit of a disappointment. We're still operating at a rate of 82% plus or minus, and we've been at that rate now for 2 years. So we didn't really do that much investment in expanding our production capacity as well as how well we're operating that. And I think the key to that is that we're only expecting to add less than 1 point of headcount back in 2025. When we've already released over 1% in 2024, we're not even going to get back to beginning 2024 headcount levels. So, there's a bit of conservatism going on here. I think the core of it all is most likely what impact the global economy is going to have on us and how we're going to impact the global economy. And like I said, when these plans are put together, there's no caveats. There's no, well, this is our plan, assuming this, assuming that. That does exist, but when it comes to the market doesn't care what you assumed. It cares whether you meet it or not. And I think right now we're trying to start out in a more conservative standpoint so that we don't try to discuss about how we're not meeting these goals as things develop. The first 6 months of the year are going to be extremely interesting. I mean, we're starting to collect some information now on our December sentiment, and by far the largest concern in December is what tariffs may or may not bring to the overall economy. And until those, so last month we talked about we need to get the election done. The election got done. The month before that we talked about interest rates coming down. Interest rates started to come down, and now we're hit here with this tactic to get attention around a lot of other things other than economics that are going to affect economics. And I think that's kind of the unknown here. I personally think the issues around Mexico and Canada are going to get resolved fairly soon, probably before the end of February. So because that's a huge issue for all of us, and if that gets resolved satisfactorily, which it most likely will, then we're able to focus more on the China tariff issue, which also affects all of us too. So. I think to go back to the demand output side.
That's good. Yeah, go ahead, Tim.
Yeah, I just wanted to kind of go back to the outlook and the business comparison to stay on the revenue side, because this kind of sets the tone for the rest of it. So our outlook is very positive. Diffusion index, at 50, it's the same as the prior year. Our outlook for 2025 is 64, so that's significantly higher than a 50. So we're feeling better about 25 than we are about 24 for sure. We're actually feeling better about 25 than we felt about 24 back in December of 23. The comparable number 12 months ago is 56.5. So that's a pretty significant step up. We're feeling much better. Okay, that's good. The business comparison for the first half of next year compared to the last half of this year is a 60 compared to 12 months ago, that number was 54. So we're feeling better again. And then the second half of next year compared to the first half of next year is coming in at a 70, which is really strong. And a year ago, the second half of 25 was a 63. So overall, we're feeling much better. But I think the issues here around hard numbers, revenue, is being driven mainly by the cost impact and what may happen to inflation as we move through the year.
Yeah. And I think some
discussing
sentiments on the capital investment side were about in the same range. But last year for the services sector, it's about 2.8% increase in capital investment. So you don't make anything in manufacturing without capital investment. Services a little different, but with a close to 4% projected revenue increase, you would think you'd see a higher employment increase number. So that was a bit of a surprise for me. Not so much the capital investment, but more on the employment side, seeing it also at 0.8%, the same as where manufacturing is.
Yeah, Steve, yeah, I wanted to come back to you on that, not only to expand on some of that a little bit, but as we get into prices, I know it was a big point that you made when I discussed this with you the other day. I mean, there were some flat growth projections on in both sectors for next year. And you made the point that, that the projections don't seem to account for, potential new tariffs. Could you just, expand on that a little bit?
Yeah, Dan, we're at 5.3% suggested increase or expected increase in prices paid in 2025 versus 5.2 in 2024. And in 2024, we had a, consumer inflation rate towards the end of the year of about 2.2%. All in all, it doesn't look alarming. But from a tariff perspective, you would think that if there was an overly high concern on tariff impact, that would be making that prices paid projection much higher than what it was last year, and it's only 0.1%. So I was surprised. That was probably the biggest surprise in the numbers that I saw, is I expected to see a healthy dose of projected cost increase. So what that means to me is that either people have their own mitigation methods that they're planning on using or shifting to if tariffs do go in various places. They've already made the shift, as some of my colleagues have, around food and hotel and operating expenses, where they've already moved out of some of the key areas, or they believe the administration saying, this is really a negotiation tactic to get other things that we're looking for.
Mm-hmm. Yeah, Tim, I'll invite you to comment on that. And I also wanted to, allude to, there was a special question, on that, in terms of, being able to pass along price increases. Were there any elements in that, that kind of caught your eye?
Yeah, that's a really good question there. So we've been asking this question now for a couple of years. Mm-hmm. Back in 2022, 72% of manufacturing respondents said that they were able to pass on price increases. This year, 56%. So it's still a decent amount. It's over half the respondents are saying that they're able to pass through price increases, but it's still almost 50% down from 2 years ago. So there's definitely going to be more of a margin squeeze. And, we saw that in the profitability forecast question that we output there too. So we're saying that profitability for the first half of next year is going to be less than it was for the second half of this year, which is a little bit of a concern. So, let me take that back. We're saying that profitability for the second half of this year is less than the first half of this year. But we do think we're going to go back to more profitability for this first half of next year compared to the last half of this year, but not really strong at 55.5. That's not a huge growth in profitability. It's 5 points above the same. And these things tend to travel in a 20 to 25 point range. So it's not huge. It's not huge like what we're looking at from the standpoint of business comparison, half one and half two. So it gets you into the cost elements. As Steve mentioned, we got a 3% price increase in 25. We've seen 3% price growth in 24. We've got a 3.2% growth in wages and benefits. That's about a 35% reduction from what we thought we were going to see in 2024. But nonetheless, you put those two together, and it's pretty much soaked up all of your revenue growth. And the numbers we're talking about here are nominal, not real. So, how do you make that profitability improve in the first half of next year compared to the last half of this year? It's got to be on the productivity side. You got to be able to pick something up. Now, there's a lot of opportunity out there. We had a whole bunch of people kind of do a lot of different things in the last 4 years, working from home, the efficiency or lack of efficiency with that. the disruptions that we had. There's a lot of opportunity for productivity improvements, I think, independent of what's happening in the AI sphere. We destaffed a lot of retired people that were highly productive and highly knowledgeable about their work. We replaced them with people with less experience. So as time goes on, they get more experience, they get more productive. So I think productivity is going to play a major role in 2025. But there's a lot of elements in here that are still unknowns. Unfortunately, the issue around tariffs, I'm neutral on the whole thing. I don't really think we're going to see it in Mexico and Canada. But the fact that it's out there every day is not helping anybody's anxiety level. And I think we could probably accomplish the same results with it being a little bit quieter. And it also appears to be the solution for almost everything, which is a problem, I think, because you don't hold up the economy for things that are not economically driven, I don't think. But we'll see what happens.
Yeah. Well, you mentioned some employment dynamics there, Tim, and let's camp on there a little bit. I mean, you saw the modest growth projections. Was that a surprise? And there was another special question that really caught my eye. For both in the manufacturing services sector, if you go back and compare the last couple of years to this year's number, hiring difficulties appear to have eased. I mean, the percentages are a lot low, especially in services. And I know that's something that, Steve and I have talked about, regularly. I mean, is there anything to be made from that? I'll let you touch on that first, Steve, since that, it was such a big, it's been such an important factor, especially in services. Manufacturing, well, there's is that also a factor?
Yeah. So what we started seeing in some of the monthly data also was that companies were starting to be able to fill open positions. The drop from 75% having difficulty hiring down to 42% was a big surprise to me in the responses. And for those that say the difficulty was going down, they were just saying local labor is more available. And so that's I guess hopefully an indication of people coming back into the job market that were out of the job market before. When you look at consumer debt being at all-time highs, maybe that's the motivation for some more coming back into the workforce. The other side of it is on immigration. There are a lot of the services sectors that, if not employment, certainly wage pressure is eased from the last couple of years of immigration policy. And as that gets tightened up, you'd expect to see some of the lower end wages starting to increase. And that's going to create pressure in the business as well, unless a common sense solution is taken towards legal immigration, work visas, things like that enable it to keep going. So I think on the ability to hire now, maybe I would attribute that to more people coming back into the workforce rather than anything more dramatic happening. Looking forward, I think there's some worries.
Yeah.
Yeah. So it's
you want to add that?
Interesting dynamics here in that question about difficulty hiring labor. We've been asking it now since 2021, when there was a real squeeze on labor and getting people on the factory floor and stuff. At that time, 81% reported that they were having difficulty. This time it's 45%. That's cut in half. And the reverse on that was only 12% said they had not had any difficulty. Now 48%, 50% are saying they're not having any difficulty. So we've probably gotten back to a normal environment in terms of difficulty in hiring people. I would, if I had to call it, I would say we're probably back to a normal level of stress. I don't have a lot of comments in my monthly PMI stuff about we're having trouble hiring people. I don't even really track I still look for the labor comments in the employment side and then the general comment side. The numbers that get commented on about having difficulty hiring people is low single digits. So it's not really a current day issue. But I find that pretty dramatic that in the space of 4 years now, we've gone from don't have any ability, 80% can't find people to hire, to only half of them saying that.
Yeah. Another question that special question that caught my eye, and that's another one that we've been asking for. ISM has been asking for a while. Was it related to the reshoring from China? I guess to the naked eye, the numbers kind of stand out, especially in regards to a lot of the chatter that you hear, about moving sourcing and manufacturing operations closer to home. Manufacturing respondents, 56 of them reported that they're not reshoring from China. That's up from 48 a year ago. Services at 5%, up from 62. I mean, those seem to be, against the grain. But I mean, is there something? Is that not the whole picture for operational moves that could be doing that, you wouldn't necessarily label reshoring? Just, talk about that dynamic, because it seems to be, as I said, against the grain of all the chatter and the discussion that you hear.
Well, we've had 6 or 7 years to reduce our exposure to the Chinese supply chain. There's, there's a couple of reasons to do that. The first one was tariffs back in 2018, and then we had the pandemic. And, and the fact that the Biden administration maintained those same level of tariffs in 2021 and forward indicates that this was not a party-specific policy. This is a U.S. policy. The surprising thing is I'm not so sure that our industry participants have really got the message. In something like this, you would I'm not sure if you get that far out in front of it, because you're probably going to give up a financial advantage for a lot of reasons. That is a whole separate topic by itself. I mean, we've been sourcing from China for 25 years now, and the original goals were a 30% landed cost reduction. That's not where you're at today. It's probably half of that, but we're still finding a difficulty in finding a comparable pricing level outside of China. And in the meantime, the last 25 years, we've moved a whole bunch of our sub-supply chain supporting the stuff that we buy into the Chinese market, where now if you're going to make something outside of China, you got to buy the stuff from China. So it's very complicated. I think industry has kind of done their due diligence. They probably have multiple sources in many cases. Some of them are not ready for this. We'll see what happens, because it means an investment, a significant investment. And I don't know that you kick that off because you think something might happen. The activity in our surveys monthly only started to show up really in the August timeframe about tariffs. That's the first time it really came back into my comment section after 3 years of being gone. So I'm wondering whether the attention around this thing really didn't pick up until the likelihood of a Republican administration started to be real. And as a result of that, things are cranking up. And like I said, I think the December PMI survey is going to indicate that tariff comments are pretty prevalent, and lots of concern and a lot of activity, and a lot of people very concerned about what it's going to mean. And like I said at the beginning, I don't think the Mexican-Canadian thing is going to turn into a tariff war. I just don't see that, and that would be a real nightmare for sure. But there is a lot of duty drawback here too. That just because we import 600 billion from Mexico doesn't mean all 600 billion gets tariffed. If there's 300 billion of product going in there from the U.S. and the stuff is assembled and sent back, that 300 billion is not tariffable, I do not believe. So that there's some upside there. It's really the value add content, I think, that gets tariffed.
Yeah, and the numbers for me, Dan, that came out of the survey looks more like the services industries have made progress on reshoring from China to the level that they can. And there isn't really a huge, 65% are saying they're not reshoring from China. But most of my contacts in the services industries, if they were able to reshore, they did that 6 to 18 months ago. Same thing for Russia production.
Yeah.
Did that 6 to 18 months ago. It's not as complicated for the most part. I mean, in construction and utilities, certainly high-end transformers and other electrical equipment, that's continues to be a problem. But for most of the services industries, not as complicated.
One of the issues that came up, one of the issues that came up, both of you, about that, I'll start with Steve, because I thought your comments on that were really relevant. What do you expect from the Fed in 2025? Do you expect a pause?
Yeah, there's nothing. There's the numbers that we're getting from both the monthly as well as the semi-annual are supportive of continued rate reductions. We're right at the same prices paid expected increase as what we saw last year, and from a consumer inflation standpoint, we're right in the sweet spot of where the Fed wanted us to be. So there's nothing in the numbers that say put the brakes on, slow down. So that's the part that I'm hopeful for, especially when you think about real estate and construction and utilities and the amount of financing that goes into those kinds of projects.
So I know we're running short of time. I'd like to comment a little bit here on the employment number, just to give people a feel for what's been happening with manufacturing employment. We're not a huge employer in the U.S. economy. Steve's side, it's like 90%. But we're in the last 5 years, we're still struggling to get back to where we were in 2019, 2020. We saw a 2.6% drop in 2020. We gained 3.3% in 21, 2.8% in 22. We lost 0.6% in 23. We lost 1.1% in 24, and we're thinking we're going to grow less than 1%. Those are pretty weak numbers. They're weak. And if you take the assumption that without people working, they don't have money to spend. If they don't have money to spend, you don't have any demand. If you don't have any demand, you got decline. Then on the manufacturing side, we're not providing that momentum, that foundational growth in employment to support a 2% growth GDP year over year. And I think that's always been our target. We've been growing better than that economically in the last couple of years, but can we maintain that level with these low levels of employment? I mean, losing 1.1% of our employees in 2024, we've been showing an employment number that's been coming down. Our hire to fire ratio has been definitely negative, but I wouldn't have predicted it was a 1.1. I would have thought it was probably 0.7, but that's a significant amount of stealthy reductions in headcount in 2024 that hopefully will be over. We'll see what December brings in January, but we're just not growing our headcount. And it's been a tough 5 years for sure. But I wish that we didn't have the tariff issue, but I know we need to address the China issue. So let's have at it. Hopefully it'll get behind us soon.
Yeah, so I guess final comments for me. Tim, I definitely agree with your commentary on Canada and Mexico around tariffs and where things would be going there. On China, the thing, not so much on the import side and cost of goods coming in. It's much more on what type of response we might get in terms of demand and our ability to export products from the U.S. To China. I mean, if you remember back a few years ago on the beef issue, there was some other things going on, and China just decided, we're not going to buy any more beef for a while. We'll let you know. And it was that fast. I mean, it just turned the spigot off. With some of the rhetoric and it being constant, I think one of your comments earlier today, it's just, it raises the stakes and it raises the possibility of things that are very impactful happening very quickly. So that's on the export side. That's the largest concern that I have, other than what might happen around labor with immigration.
Yeah, well, thanks a lot, guys. That was a great discussion. And yeah, I apologize here without breaking up. But yeah, thanks for joining us. If you'd like to be a part of the ISM manufacturing services or hospital business survey, CPSM World Data Panel, it's just each month. And join us for another LinkedIn Live session on January 3rd, when Tim and I will break down the December manufacturing PMI data, and on January 7th, when Steve and I will do the same with the services PMI. So for Tim Fiore, Steve Miller, and some people who helped us behind the scenes, Christina Cahill and Jennifer Stevens, my name's Dan Zeiger. We'll see you next time, and hope you all have a great holiday. Take care.